talked about this for years. I was bullish on silver and gold. I'm confident now that that 55.6 level was the correction bottom, and that we have begun the turn. Obviously today it's coming out of a little bit of a pullback yesterday, and it looks like it can go higher. There's still going to be pullbacks. It's still going to be, you have to be careful with it. But I do think once it breaks above a certain level, and I'm not sure whether that's, I see 72 right now as the next stop. But
mentioned silver. There's only about 4 people on this show who've mentioned $1,000 silver that come to mind: Michael Oliver, Lynette Zhang, Francis Hunt, and yourself. Michael Oliver was very bold with his call. He believes silver could go to 1,000 within 1 year.
He can't get there myself to Michael's numbers, but I don't think he's crazy, and I certainly don't discount his experience and knowledge, and it's certainly possible it exceeds my expectations for this cycle. But right now, 200 is as high as I can get, and I raised it. I had it at 125, I think, going into January, and then raised it to 170, I think, and then raised it again to 200 at the end of May. So, but that's, I'm pretty confident with the 200. I just can't get to the 3, 4, 500s that Michael's talked about, and certainly not 1,000. The 1,000 for me is probably a 2032 or 3 type period, but you can drive a truck through how much you can miss that by. It could be 2 years either way, but it's the next cycle really getting driven, and it comes from a lower level in the bust. I do think the metals will, as they always do, get hit in a big market correction, in a recession, or what in this case is a bigger than recession type downturn.
Silver hitting $200 sounds extreme today, but the more important question is why investors keep underestimating what actually unfolds after a monetary reset. David Hunter notes that $200 is his current ceiling, while $1,000 belongs to a much later cycle, meaning the real opportunity might not be the headline number itself, but the sequence of getting there. Markets repeatedly punish investors who insist on certainty before they'll buy. If silver reprices violently, waiting around for confirmation could mean paying multiples more later.
But, those that are very turned off by the fact that, silver got to 122 and rolled over and has been down for months, and it shook out a lot of weaker hands. As you know, because we've talked about this for years, I was bullish on silver and gold, 2, 3, 4 years ago, and it took a while to get going. Gold got going before silver, but silver, I took a lot of heat because when it was in the mid-20s and just couldn't get out of its own way. It was trade, and particularly the miners, but between, mid-20s and the high teens, and then it got up to 30 and then backed off again. People just didn't believe that it had the kind of legs that I talked about. And then when it finally broke out and took off, that's when people jumped on the bandwagon. So they didn't buy it at 30 or 40. They bought it at, 60, 70, 80. And then they're really upset because they lost money. But that's markets. Once things get too ebullient, the market has a way of basically bringing back the discipline, shaking out the weak hands. And because the run from 50 to 122 was parabolic and happened so dramatically, it took months to correct. And I can say that looking back, I didn't know that it was going to take 6 or 8 months to get going.
The most dangerous moment in a silver bull market might be exactly when investors finally decide the story is over. Hunter argues that the plunge from $122 wasn't proof silver had failed. It was the kind of violent reset that shakes out weak hands after a parabolic advance. The uncomfortable lesson here is that retail investors often wait for certainty and end up buying only after the explosive move has already happened. That mistake can turn ordinary volatility into a permanent missed opportunity.
I'm confident now that that 55.6 level was the correction bottom, and that we have begun the turn. Obviously, today it's coming out of a little bit of a pullback yesterday, and it looks like it can go higher. There's still going to be pullbacks. It's still going to be, you have to be careful with it. But I do think once it breaks above a certain level, and I'm not sure whether that's, I see 72 right now as the next stop, but I know Michael's probably talking higher than that. But there'll be corrections along the way, but I don't think they're going to be long lasting. They might last days, but not months. It plays a role. I mean, if you price gold in various currencies, you'll see differences in returns because currency matters. Obviously, the dollar in the last year has been up, and yet gold had a nice run. So it hasn't been the case near term, but I do think the big move from 4,500, 44,500 here to 7,000, a lot of that is going to be currency. I mean, the dollar, I have the dollar going to 83, something like that, over the course of the next 6 or 9 months or less. And if that happens, it's a big part of the move to 7,000, I think. It's more than that, though. Obviously, rates coming down, which, as I said, I think rates peaked yesterday. And I don't usually try to call things to the day, and I didn't call it, but I don't usually pinpoint things like that. But it looks to me like you finally got to max pain, max bearishness, and then obviously what Bessent announced today, helps. But I have rates going down from here for the next 18 months. It'll start gradually, but ultimately, like I said, you could get 10-year down to zero. And that first move down, let's say from, the 460, 70 area down below 4, I think is going to help gold. That'll be trading down well. The rates will be trading down well while gold's moving up and silver's moving up. And then I think you can get a faster move from there down to 3 or even below. That will be kind of that final move up towards those numbers.
Gold's next major move may have less to do with gold itself and more to do with the currency sitting underneath every quoted price. This is where Hunter's argument shifts toward a falling dollar, declining yields, and a potential 10-year treasury rate approaching zero, an unusual setup where rates fall while monetary assets rise, challenging the assumption that gold needs a strong economy to perform. For savers, that means currency depreciation can quietly erode purchasing power even while nominal portfolio values climb.
But certainly Japan is right up there as a candidate. I mean, they have maintained zero interest rate policy forever and have basically kind of looked like you had made monetary theory extinct, that you could print money forever and not have inflation. And I'm a monetarist pretty much. And I just think what we're seeing now is what should have been expected, is that at some point, yes, they are more homogeneous society, and they had lots of things that they could kind of that help them keep inflation in check for a while. But now it's breaking out, and so will rates. Rates track inflation, and that's their problem. Is they've for decades they maintained this policy and thought they could get away with it. Well, guess what? Now it's you postpone the monetary response, but or the response to the monetary, but it's coming now, and I think during the next year you will see rates keep pushing up there, and they just don't have. I don't think they have the leeway to deal with that. And I mean, I have the yen going, and I do yen dollar, not dollar yen, but the yen to the dollar I have going to 0.0085, and it's down around 0.0063 something, 635 say. So I have the yen going pretty high here over the course of the next 6-8 months. And the dollar obviously is going to be down against the euro, the yen, even the other dollars, Canadian dollar and the Aussie dollar, etc. So, but but I do think that in the bust, Japan's going to be probably one of the places where it's just over leveraged, very over leveraged to that policy. And as I have preached over and over, leverage works both ways. On the way up, it enhances returns. We're seeing that here in our markets, in our in everything we do, and leverage decimates you, as we found out in 2008-9. On the other side. So that's basically my reason for having a bust is we've got 330 trillion plus in global debt out there. And, certainly China's a big part of that. Certainly the US is part of that. Japan's part of that. All Western countries are part of that. I'm not calling for a sovereign crisis because they have the printing press. But there's a lot of private debt out there that I think is going to have a problem. Certainly commercial real estate. We'll find out there's another shoe to drop there. Private equity, private credit, etc. There's plenty of candidates where once this thing rolls over, once something triggers, you're going to see an awful lot of things show up.
And given everything we've discussed so far, where would you be looking in the market today for potential opportunity? Because obviously we're in a very uncertain market environment. You believe that the broad market's going to continue rising. That could be difficult to time for your regular average retail investor who doesn't know how to look at charts and doesn't understand a lot of the macro behind it. That's the issue we've come to in today's investing world, is this passive investing, as you were speaking of. People now believe that the stock market is a high interest savings account, that you put money in it and then you just wait, and over time you're just going to keep making more and more money. And I think that I agree with you that paradigm is rapidly changing. So with all that in mind, where would you be looking to invest today? I know you mentioned long dated US Treasuries before. Is that an area you're bullish on, and anywhere else where you're seeing potential value?
Yeah, so it's a little tricky, and people jump ahead because I do have my 0% Treasury call. But it starts very slow. So there's a period in here. And again, everybody has to figure this out for themselves based on their own experience and risk tolerance, et cetera. But we're in a funny place where, I have a 90 number for XLF, the financial ETF. And I'm not sure where that is now, but that's more than a 50% move from here, I think. And so there are still, when you figure the numbers, there's 2 and 3 year returns still ahead of us that are going to happen in a matter of months. So you have to look at both time and, what the upside is. And so I just caution people, even though, and again, some people should probably, because I could be wrong, lots of the call could be wrong. So you have to understand the risk we're at when we're this late in the game. However, if I'm right and there's 30, 40, 50% returns left in some of these areas, you run the risk that you jump out now and say, I'm just not smart enough to time the top and I'm nervous, as you've been nervous since 2020. A lot of these people have been nervous all along, particularly institutions. But if you jump out now, you run the risk that if you get this final parabolic run, it's going to, psychology being what it is, it will suck you back in for a lot of people. And they'll end up getting out, understanding what's coming, but then getting sucked in by the fact that, hey, how do I know this is the top? I was wrong. I missed on 30, 40, 50% returns. And people are telling me there's 2 and 3 years to go on this. I got to get back in. And then you get back in at the top. So I just caution people. And again, it's not advice. Everybody has to kind of figure out for themselves. But just know, if you decide you're getting out early, don't get swept up into the emotion of it. Secondly, and treasuries will be, I think, at the top of the list of things that will protect you in the bust. There are very few things that aren't going to go down, and treasuries, I think, are going to be one. And that's both from the very short end all the way out. If in fact rates are falling during the bust, as they should, the long duration is where you're going to make the most money, but it's also the place where, if I'm wrong, you're going to have more volatility.